Good morning and welcome to our first podcast. Sorry for the slight delay. This is a new thing for us, so just getting used to the technology, but I'll just kick off. I'll get down. Okay, there's just our general disclaimers. We will be releasing this presentation, but what we're going to cover today is we're going to give a bit of a market update on what's happening in the Aussie small cap market, some portfolio insights for our portfolio, and how our portfolio is positioned for the next 6 months. So what's happening in small caps? This is what's happened with small caps over the. You can see the top line in red is the top 100, and the blue line is the small caps over the past 12 months. So there was quite a dramatic shift in market sentiment. It correlated with the US election and Donald Trump being elected. And that occurred in November last year. And what we started to see from that point in time was really a change in people's risk profile. There was a lot of investors that were invested in small caps that weren't sort of traditional owners of small caps. And so we saw a pretty big sell-off, as you can see, in small caps, and a shift from some of those larger cap fund managers into out of small caps into big caps. So it put quite a lot of pressure on small caps. And what had happened, we'd had quite a lot of cash in the portfolio since about August last year, and because we felt things were overvalued, because there were a lot of people in a lot of stocks that were sort of traditionally not owners, it resulted in some PE expansion of some of those businesses, and we just thought they were expensive. So we were really sort of struggling trying to find good quality cheap businesses. So that situation has changed quite dramatically now, and what we're starting to see is there is a lot more value in the smaller end of the market. So, we're quite excited about the outlook now because all of those, there has been a lot of carnage out there, and there's been a lot of people selling off the smaller companies. So just on this slide, we've got a list of some of the large companies that during reporting season had pretty big downgrades. And some of these are quite big businesses, things like Ardent Leisure, which has had issues in the US with its business, Channel 10, which is a large business, Sky New Zealand business, GBST, Hansen Technology. So all of these companies, massive share price re-ratings, and this has started to cause a little bit more fear in the market. So that's further exacerbated that shift out of small caps and into large caps and more secure type investments. Since the end of reporting season, there's been quite a lot of downgrades in small cap sector, and this is just a list of some of them. And some of these companies are quite large companies. They've all downgraded, and we've seen massive share price retractions in all of these companies. So for us, that's an exciting sort of time. Fortunately, we've managed to avoid most of these businesses, and as a result, our performance hasn't been grossly negatively affected. And you'll see some of the other small cap players out there have had pretty significant negative months, some months. So we're happy that we've avoided all of that. But this all creates opportunities. So this list of stocks here, we're working our way through some of these because some of them really have been quite dramatically oversold. And so, we're working our way through some of these businesses now to try and find opportunities. At the same time, it is quite difficult making sure that there's not further downgrades in some of these businesses, and there's not, structural reasons for the downgrades. But, this quote here on this page sums it up quite well in that this is really the time that you want to be buying and looking at small caps. There's been a big sell-off. They've underperformed large caps, and there's a significant amount, as you've just seen, of companies that have really been sold off quite dramatically. So we're optimistic about the outlook. They might not turn around quickly, but for us, if you've got a longer term view and you're a patient investor, some of these companies will present opportunities, and they suit the way that we try and invest. So what opportunities are we seeing? Look, there's still a lot of small companies out there, especially in the microcap space where we play. The size of GC1 allows us to get in and out of quite a lot of companies. There's just under $50 million in GC1 that's investable. that allows us to get right down into the very small companies. You know, when you're sort of getting up into over $100 million in terms of investable funds in microcaps, you really start to narrow out your range of opportunities. And a lot of the segment in this chart here on the right, a lot of that disappears as you get bigger. So our size allows us to take advantage of a lot of these opportunities, and we're still looking. In terms of how that is represented, just in terms of number of companies, you know, there are only 100 companies in the top 100. There's 2,000 microcap companies that are out there listed. There's about just under 2,400 companies or entities listed on the ASX at the moment. So we've still got a pretty big pool of companies. A lot of them are not investment grade, but massive opportunities. And we're still out there seeing companies, doing a lot of company visits and trying to identify value. And now there's this whole new segment of sort of quite deep value in these companies that have been recently sold off. So where we try and position the portfolio, you know, we're quite vocal about it in the videos that we do each week. If you're not getting those videos, you can subscribe to our channel on YouTube and get them, or subscribe to our newsletter. But, you know, we do like the owner operators, people with skin in the game, significant equity positions in the businesses that they're operating. We still do like that roll up and roll out category. And the Australian market tends to lend itself towards that structure, and we've seen it do well over a long time. But you need to be careful. There's a time to get out, and there's a time where buying too many businesses and not integrating them carefully it can blow up. We do like the very small microcaps things where it's a bit of a binary decision about how the business will go. And what I mean by that is they may get a contract or may not get a contract. If they get the contract, the business will be a good success. If they don't, then there's really not a lot of value there. But you do have to take risk. We constrain that risk in the portfolio. We like to have it around 10%, but it is about 14% of the portfolio now, that true sort of microcap position. And we increase the weighting as those as decisions become less binary. So if they do win the contract and they start to be a little bit de-risked, we'll start to put more funds into that business. And that final category is that sort of deep value thing where we see good businesses that have been oversold, and all those companies that have had downgrades recently. Some of them are quite good businesses. They're trading way below where they should be trading. And so we're looking at a few of those businesses. So in terms of insights from the portfolio, what I might do is I might just hand over to Alex. And, you know, one of the things that we're quite optimistic about, and we've got some exposure to in the portfolio, is the tourism sector. And I'll just hand over to my colleague Alex. He might run through that.
So tourism's been one of the sectors we've looked at relatively closely, and we've got a couple of positions in this space. Now, one of the major drivers in this space really is the number of inbound short-term arrivals. So if you look back, and we've looked back a fair way here to 91, you actually had some very decent growth for 10 years there. You had a pause gradually, well, slowly, for the Japanese tourism that went quite significantly backwards during that period, and obviously the impact of 9/11. And then you had a high Aussie dollar, which constrained that growth a little bit. But really in the last 3 years, we've seen a lower Aussie dollar. We've seen increased Chinese tourism growth. And you can see that there on the left, and really broken out on the right-hand side as well, because Chinese tourism has really been one of the bigger drivers for overall arrivals as well. So we'll flick forward here. The chart there on the left shown the contribution that we see to growth. So the amount that the Chinese arrivals have contributed to total arrivals. So it's really been China driving the pie over the last 3 years, despite, say, New Zealand being a larger still contributor of current arrivals. And on the right there, there's a bit of a forecast from Tourism Research Australia that shows that really that trend is most likely going to accelerate going forward. So what does that mean for some of the tourism stocks? It means really you're looking at higher volumes of people coming through the door. And in sectors and in companies and segments where you're constrained capacity-wise, you can really start to increase prices off the back of more arrivals. So we've got a couple of exposures in this space. One is Skydive the Beach, which is the largest tandem skydiving provider in Australia. What the business has been doing recently is they've occupied that tandem skydiving space, But in addition to that, they've branched out into adventure tourism and leisure. Now, obviously, it shares some characteristics. You're marketing to a similar group of people. You obviously can use the same fixed cost base that was established in the skydive business. And the business overall has some pretty strong industry positioning in its core business and is starting to do the same in its new branches in adventure tourism and leisure. The core market continues to grow, and those arrivals are really feeding that market. Further acquisitions will really help that business along as well. On the Apollo side, I mean, that business in Australia and New Zealand is well established in the RV rental space. And we've seen them branch out as well into the US, into more retailing in Australia. And again, that there is a domestic component to that, but a large part of the driver is inbound tourism. So we've got tourists coming to Australia. They rent out an RV, they drive around. If there's capacity constraint, which there can be at times there, that helps on pricing as well. So the next component we're going to tackle is retail, and happy to walk through that as well. So at the moment, there's a couple of different headwinds that we see on the retail side. One is obviously household debt's been building for some time, and you can see that in the chart on the left-hand side. While interest rates have been lower, you can see that the real repayments haven't been as high. So it hasn't been as much of a perceived threat to people's household budgets. But as that debt level increases, and as wage growth rather has come down, which you can see on the right-hand side there, really households have become a lot more sensitive to this picture. And so high debt with low growth in wages has really been an issue for household spending. And people are making a little bit of a different decision as well now. They're tossing up whether we spend on that next new product or we put the incremental amount of money that we have into our savings or into paying down our mortgage. You can see that in the chart there. So there's some results of surveys. You can see that the more people are willing to pay down their debt, the less willing they are then to spend on retail, because that dollar can't go both ways. Retail sales as a result has really come down, and you can see that on the right-hand side. So we have had relatively high levels of retail trade growth, and that's come down significantly in the last little while. So that's the macro aspect for retail, but really there's another threat for a lot of the brick and mortar retailers, and that's the online piece, which I'm sure you would have read a lot about. There's been a lot of noise about Amazon. Before that, there was a lot of noise about retail, but I think it's really starting to come through in the threat and in kind of tackling the core profitability for this industry. So retail is obviously going to be growing online, and you can see there's countries that are more developed on the online space, like the United States, that have significantly higher, here 11% versus 7% of online sales. Amazon's really the other big threat here, and you can see there that there's quite a lot of the larger listed retail players that have substantial impacts from Amazon coming in. So something like a JB Hi-Fi might well have a 30% downside on the EBIT once Amazon's rolled out substantially. And that number at the moment is very uncertain, so it could be substantially higher. So at the moment, we've got no exposure on the brick and mortar retail side. It seems like the pool for local retailers is actually shrinking. So we've got the online retailers claiming the offline pie, and then we've got the international retailers, Amazon, coming through and claiming both the online domestic and the offline domestic pie. Meanwhile, the business models for retail businesses are actually quite highly leveraged, and so a lot of them are built on increasing retail sales over time. So substantial margin issues could come about. And we've seen a lot of that in the press recently. We've seen a lot of businesses fall into administration. There seems to be almost one every day in the press. So really, where to from here? And it seems sentiment's likely to remain poor. Amazon will either enter the market in in full, or to the extent they can locally at first, later this year or early 2018. They've already got significant amounts of sales here. And so then it'll be a matter of sorting through the affected local retailers and to what extent they've been affected, seeing if there are some opportunities as people throw the baby out with the bathwater. So on that, I'll hand back to Michael to talk through GC1.
Yeah, so I'll just give you a bit of an update on recent performance, dividends, and what we're doing to try and sort of communicate and be open with shareholders about where we're going and how the portfolio is positioned, which is important to us. So look, we're still focused on small and micro cap companies. There's 39 positions in the portfolio at the moment. The median market cap of those businesses is about 200 million, and there's about 45 million in the fund at the moment. So, which is a good size. It lets us get in and out of positions. But I guess the negatives of that is that, you know, it does affect our liquidity being a smaller company. In terms of dividends, we're pretty happy with the dividends that we've been able to pay so far. We've got provision to pay further dividends, but for the short period of time that we were listed, we paid that interim dividend in 2016 of 0.75 of a cent, which we fully franked. We declared a final of 3 cents, which is also fully franked, and we've just increased the interim dividend to 1 cent. So that was sort of a significant increase over the interim from 2016. So we're happy with that in light of the fact that you know, the options were exercised, and we were able to pay you know, dividends on the fully expanded capital base of the company. And I was quite happy because I guess, look, you could leave half of your cash, half of your money sitting in cash, earn interest on it, exercise your option and get paid the dividend. So as a shareholder, I was very happy with that outcome. And we expect to be able to continue paying fully franked dividends going forward. In terms of the long-term performance, you know, this is the long-term performance of Glennon Capital as a business. And then we've got the annual numbers a little bit shorter, a little bit less than what we've done on an annualized basis as a company over the last few years. But I think that's more characteristic of what's happened in the small cap market. But over the last year, it was still 9.5% gross portfolio return. Some of that was diluted because of the on a net basis because of the option exercise. But as I said, look, you're able to leave half of your cash sitting in the bank earning interest at the same point in time. There aren't any options outstanding now, so the gross returns will be a lot closer to the net returns, and I'm pretty optimistic about the market. Whether that comes through in performance, you know, in the next 6 to 12 months, I don't know, but it's a good time to be buying small and micro cap businesses. You'll see there's a lot of other companies out there that are launching micro cap funds. I guess the advantage we've got over those other funds is that that's all we do. You know, there's a lot of the people listing them are, you know, running broad cap strategies, all cap strategies, and larger fund managers just looking to capitalize on the micro cap market. I just think we'll have an advantage over those guys because that's all we're doing and all we're looking at, and what I've spent, you know, the last 20 years doing. In terms of communicating, we try pretty hard and put a pretty big effort into communicating with shareholders about our views on the market, what we're looking at, companies in the portfolio. So we're pretty active in you know, on our website, on a Facebook channel, on Twitter. We do the videos every week, and the newsletter subscribers are growing. We have pretty high open rates, and I think that's because, you know, most people are generally interested in a lot of the information that we're putting out there. So now, just in terms of some investment case studies, I'll just go through. We've been pretty vocal. I mean, we try to be long-term shareholders. So if you've been a shareholder in our company since we listed, you know, being pretty vocal about liking National Vet Care. You see recently the share prices, it was probably a little bit overvalued, but this is a company that fits into that category of you know, making acquisitions and growing its market share. So it's still got a single-digit market share. It still trails Green Cross. It's a veterinary. For those who don't know, it's a veterinary business. It's acquiring veterinary practices. I like the business model. You know, animals get sick regardless of what happens in the economy. So it's got a nice revenue stream that's not affected by what's happening in the US. What is affected is the price of the shares, and as some people will see have come back recently, but it's been a great investment for us. It's the largest position in the portfolio. It's got excellent management running the business. They're able to buy the business on quite attractive multiples. We keep an eye on the multiples that they pay, and they do quite smart things in terms of increasing the gross margin in the business once they make the acquisition. Things like they've got centralized purchasing of product that goes into consumables, as well as pet food that's sold in each of the centres. The corporate costs are very low on a head office perspective, and really amongst Green Cross and National Vet Care, they only have about a 12% market share amongst the two of them. So the market's still heavily fragmented. There's still a lot of businesses out there that they can acquire. That companion animal theme is growing. More and more people, are buying animals and spending more on those animals as they get, higher levels of income themselves. So things have really changed with the amount of money that people spend on their animals. NVL does great things with. They've got a program, for example, a wellness program. So, for example, you enroll your dog in the wellness program, and they'll give you 6 monthly reminders to get the teeth dental checkup done. So people are, starting to increase the level of care for their animals almost to a human sort of level. And this is all extra margin that they can get out of a centre once they acquire it. So we're still optimistic on National Vet Care. It's done very well for us. I think we paid $1 for it in the IPO not long after GC1 listed. Shares are currently about $2.40. So it's been a great investment for us, and we think it's going to do well over the next couple of years. Moving on, one of the other businesses that we talk about quite liking, and it's a really good theme in micro caps, is disruption. So businesses that are able to sort of disrupt the existing status quo in the economy. So Zip Money is one of those businesses. Some of you might have actually come across it when you're shopping online or when you go on to a retailer, but they've really changed the way that people get short-term finance. So what they do is, for example, if you go to a Freedom Furniture, you used to have to go and apply for credit if you want to finance, purchase of a sofa or a dining room set. You used to have to apply for that through a GE Finance. Some of the larger offshore groups have moved out of that segment, but where Zip Money's really been able to benefit is the fact that they've been able to integrate a technology solution so you can get an approval very, very quickly within a couple of minutes. So they give you an iPad, you go in, you fill out all of your details, and the retailer loves it because it means that there's not a half an hour wait as there was in the old style of approval for getting this credit. And in that time, the consumer might change their mind. So the retailers like it, very fast approval, but then they have the ability to provide that line of credit to the customer ongoing and into the future. So it's a good business. We like the technology. We like the market share growth that they're getting. And the other thing that's just happened is that they have de-risked their business a little bit by, they announced a couple of days ago that they've got a new bank funding facility. The stock was up 12% off the back of that yesterday. So things are going well at Zip Money. It's a small business that's growing, and we think it'll continue to grow as it provides a new technology into an old market. In terms of contact information, we have moved office, so if anyone's looking for us, we're now in 25 Blythe Street. As the business has grown, we've put a bit more resource into the business, and that's the rest of the postal details. So we've had a couple of questions come through. I'll just read out the first one. It's in relation to Certex, which we had held historically, and we did very well out of the shares. As a business, Glennon Capital originally bought those shares, I think it was about $3.50 many years ago. But the question says, look, we indicated we don't own any Certex anymore. What was the catalyst for exiting the position, and what was the exit price / overall return? So as I mentioned about the overall return for the shares, it had been a very good business for us for a long period of time. Shares are about $12 now. We got out at much higher prices, and our original entry into our unlisted small cap fund was about $3.50. So it was a great investment for us. But what changed is we really lost a lot of confidence with management in the US. They've lost the guy that was running US business. And one of the risks, we don't like buying businesses where we're not generally a big fan of buying biotech businesses because we don't have medical expertise to assess the relative merits of the science. The thing with Certex, it was cash flow positive. It did make a profit. It was selling Cerspheres into a treatment for liver cancer. What we liked about it, there was a lot of optionality about using the existing technology, the Cerspheres, to treat other types of cancers. Some of those didn't work out, and the results of those trials were negative. So that, combined with the fact that there was issues in the States with the guy that was running the business, was one of the catalysts for us to exit the shares, as that decision turned out to be correct, and the shares are about half where we originally sold them at. The next question we've got is, what are some of the questions we ask when we're looking at investing in a company? There's two, when we go out and we meet management, there's two styles of questions that we ask. One's around getting clarity about the financials and the numbers that the company's reporting. And the other are more subjective questions to try and assess the quality of the management, the quality of the business, and the quality of the markets that they operate in. And I guess after you've been doing it for a while, you get better at gauging, the level of enthusiasm that management's got. So the numbers are reasonably simple for us to understand. We try to pick out questions that will give us the key drivers of what it is relative to that business that's going to make it be successful going forward. And the other is, we really want to gauge how the quality of management. So the smaller the business is, the harder it is to try and gauge the quality of management. But one thing, and why we're quite vocal about having people that are owner-operators, and why we tend to favour those people, is generally they might have had a private business that they've taken public. They've got a track record in building a business, and they've got a lot of their own money invested in the business. And their main driver is not actually getting a big paycheck every week. It's actually about the value of their shares increasing. So that gives us comfort that they'll make good long-term decisions about the strategic direction of the business. Quite often fund managers get carried away with 6 monthly performance numbers. If you run a business, things don't always go, and contracts and things don't always happen every 6 months. Sometimes you might miss a contract by a month or two. Nothing's wrong with the business, but yet the shares will get sold off. So we like to see passion and drive and energy from management, but we also want them to be conservative with what they tell us and not sort of promise us the world and only half deliver that. You see that quite recently. There was a great article last week on One Page, which we were quite vocal about not liking the business. But when you've got a salesperson running a business, they tend to overpromise and underdeliver. That's one of the things we dislike about some management. We want them to be conservative and actually tell us what they think they can do and what their long-term plans are and where they want to take the business. So they're the types of questions that we ask. We'll ask what the company's plans are for capital expenditure. We like to see that the company's sort of pretty frugal with shareholders' money, because when we buy that business, we treat that our shareholding in that business like we're an owner of the business. We've got as much rights as any of the directors that are on the board of the business. We want to make sure that they're doing the right thing with our money. No different to any of you would do if it was your own business. You wouldn't want to be wasting money or seeing people that you'd hired to run your business wasting money. So that's the way we think about the businesses. That guides our questions about what we're trying to look for when we're out seeing businesses. The next question we've got says there's been increased activity in listed investment companies involved with microcaps. Will this impact on the segment, and is it positive or negative for Glennon? So I think overall, obviously we're big fans of LiCs, and I think microcap LiCs are the perfect vehicles for investing in that segment of the market, because you don't get big redemptions. And you'll see there's been funds recently, small cap funds and micro cap funds that run unit trusts who've had key people leave, and they've had massive redemptions from their portfolios. They've had to sell shares. That's another thing that's impacted the small cap market. We're not subject to that, so we can take advantage of those short-term weaknesses in the market, which I think there is at this point in time, with more selling than buying in small caps. I think it's good that people are raising money for micro cap funds, And I think it's great that there's more companies that are listing as LiCs, because I think the ASX is a great platform. If you want information on GC1, you can go to the company announcements. You can get it on your mobile phone through, a mobile app for, share trading. You can get it from the ASX website, and you can get them off the internet anyway. Yeah, it's very difficult for many of the big fund managers. I've been in the market 20 years. If you ask me to find money, find information about who's running a Colonial or an AMP or a BT small cap fund, I'd have no idea if I had to go and get it off their website. Whereas with all of the LICs, it's very, very transparent. All of the information's there. It's simple to work out who's managing your money and what the returns are and what fund you're actually investing in. So yes, more LICs I think is good. I think it's a great, clear, transparent platform. Given the number of companies and the number of investments that we hold just under 40 positions. And I'd say there's maybe, I think there's not a lot of microcap funds that are publicly available out there that I can think of. There's probably only, 20 funds. There might be more, but, if they're all owning 40 stocks, there's still a lot of other companies out there that are listed. There's over 2,000 small microcap companies listed. So there's enough room for a lot of people, and the actual dollar value of those companies is actually quite small. So I think it's positive for the sector. And the other thing is there'll be more companies listing, and if there's more small microcap funds, that provides access to capital in the market will get bigger. So I think it's good for everyone. All the investment opportunities are not mutually exclusive. So if there is more capital, good companies are listing or raising capital, we talk to a very, very broad range of investment bankers and stockbrokers about capital raising. So that's positive for our returns also. The next question is, when looking at the current Australian market, in which sectors can you find stock value and what would you avoid? So look, we've already mentioned that we'd avoid retail. We also try and avoid, we don't invest in any exploration resource companies because it's really just, a guy with a shovel standing out there saying, look, I think there's something down there. So I find that hard to value. My view is if the market shut down, you would really want, and that was your investment was the only investment that you had. So for example, National Vet Care, if the market shut down, that was the only business I've got, I'm happy that it'll be a bigger business in 2 years and I'm significantly wealthier. Or conversely, it might be a business that if the market shut down and the share price was $1, it might be returning you 10% dividends every year, and I'm happy with that situation as well. With a guy with a shovel standing out there telling me that he thinks that there's something underground, it's a long way between making cash out of that business, and that's really all I'm concerned about. So we tend to avoid all of the resource exploration companies. We tend to avoid speculative things where there's a lot of blue sky and we can't understand where the cash is going to come from or the business model. We avoid biotechs that don't produce any cash flow because we don't understand the science and we don't specialize enough in that segment to be able to do it. And where we think there's value, there's a lot of value in all these companies that have been sold off significantly, and even some of the retailers that have been sold off. Their businesses are not going broke, so this may be a great opportunity, and we're working our way through them now to actually get companies who are very cheap. So that's another area where there's significant value. So even if you get that list that we've just put out and work your way through that, some of those companies have been oversold quite dramatically. In terms of other questions, we've got a question from Eon Financial, and it says, Big Un's been a great investment. Are you still holding it? Actually, we did a video on Big Un. We never actually bought it. We just wanted to watch the space. I think it's the share price performance has been great. We're keeping an eye on it. What we didn't like was the profile of cash flow on that business. It's negative. It's very strongly negative. I think they'll have to raise capital at some point in time. I understand they're putting in place measures to reduce the cash burn, but we're not there at the moment. But we are watching that business. Now, the next question we've got is, we seem to turn over the portfolio a lot. No, I think the average turnover over the last 7 or 8 years has been about 40%. It has increased recently. That's a function of, I said earlier, the small cap sector got very expensive towards the end of last year, so we sold out of quite a lot of positions, and I think that the turnover's normalised a little bit. The other reason, when we first funded GC1, some of those positions we'd done well out of, and then we'd held for several years. Things like Silver Chef, which was another great investment for us. We'd held for 5 years. It just happened to be that we were exiting that investment not long after we bought it in GC1, but as a business, we held it for many years. So I think that turnover will normalise, but it was also high because getting funded and also raising additional capital in the fund increased the turnover. But no, ideally we want to own. Well, I want to buy a business that can keep going up every year, for the next 10 years and not sell it. But things change, things get fully valued, management change, companies make acquisitions. We don't like the acquisition, and it's a characteristic of small caps. So, but ideally, buy one investment, hold it for a long period of time. You can make great money. All right, I think that's it. We don't seem to have any more questions. Thanks for listening in, and as I said, we'll be releasing this presentation through the ASX platform. And if you want more, as I said, please